If you've inherited an IRA in the last few years, there's a good chance that you're doing it wrong. Not because you're careless, but because the rules changed twice in the last 5 years, and the IRS didn't finalize exactly how they work until 2024. Missing a required withdrawal can cost you 25% of what should have been taken out. Let's make sure that doesn't happen to you. For those who don't know me, my name is Riley Siltman, and I'm a certified financial planner professional. Inherited IRAs come with a set of rules that most people, and honestly a lot of advisors, find genuinely confusing. So let's break it down step by step. Let's start with the 10-year rule. Here's the headline rule. If you inherited an IRA from someone who passed away in 2020 or later, and you're not their spouse, you have 10 years to completely liquidate your account. That's a big change from the old rules because you used to be able to stretch withdrawals based on your own lifetime. But here's the part that trips people up. Whether you have to take income every single year or whether you can wait to take it all at the end depends on one factor. Had the original owner already started their RMDs before they passed away? If the person you inherited from was already taking RMDs, meaning they hit the age 73 mark, you're required to take annual withdrawals in years 1 through 9 and take whatever is remaining and empty it in year 10. If they passed away before reaching RMD age, you generally do not have an annual requirement. You have more flexibility on your timing. You could even wait until that 10th year and take it all out at once. But the account still needs to be emptied before that deadline, the 10-year deadline. Now, the distinction wasn't fully clear for a few years. The IRS went back and forth and issued penalty relief for those who didn't take RMDs between 2021 and 2024. But that relief doesn't carry forward. If you are now in the RMD annual phase, you need to be taking them now. Now, not everyone is stuck with the 10-year rule. There's a term called eligible designated beneficiaries. These individuals can stretch their distributions based on their own lifetime, similar to the old rules. This includes a surviving spouse, a minor child of the original owner, though if they reach age of majority, the 10-year window starts, someone who's disabled or chronically ill as defined by the IRS, someone who isn't more than 10 years younger than the original owner. If you fall into one of these categories, your options and tax planning become very different. I want to discuss a few common mistakes that I see. One is assuming that you don't need to take anything out during the 10-year window. If the original owner has already started RMDs, you need to be taking them out on an annual basis. If you do not do so, this will trigger penalties. 2, not accounting for the year of death RMD. If the original owner hadn't taken their RMD for the year that they passed, generally speaking, the beneficiary needs to take the RMD before December 31st of that year. Number 3, taking the whole balance in years 1 or 10 and not spreading it out. A large lump sum withdrawal can push you into a much higher tax bracket in that year compared to taking little amounts every year. Quick note, if you inherited from a spouse, you generally have more flexibility than any other beneficiary. Most surviving spouses choose to roll that IRA into their own IRA, which allows them to treat it as if it's always been their account. That's an entire separate conversation, but I wanted to note that you are not boxed into the 10-year rule as a spouse. Inherited IRAs sit at the cross-section of tax planning and estate planning, and getting your timing wrong can be an expensive mistake due to the 25% penalty. If you've inherited an account and aren't sure what rules apply to you, it's worth having a conversation before making any withdrawals. If you would like guidance, feel free to reach out. If you found this helpful, please consider liking and subscribing. Thank you for watching and take care.